All right, class. Good evening. You're welcome again to another class on financial reporting. Today, we are going to be looking at analysis and interpretation of financial statements. Analysis and interpretation of financial statements. So last week, we successfully looked at non-current asset held for sale and discontinued operations on IFRS 5. Very short and straightforward standard. We took our time to look at it in depthly. We also looked at IAS 40 on investment property as well. Tonight, we are going to be progressing with analysis and interpretation of financial statement. So this is a very key topic for you guys. Key in the sense that you would always find it in your exam. So it's always there. You see, so far, we have learned preparation of financial statements, focusing on accounting standards. We have taught you how to recognize and measure property, plant, and equipment. We have taught you how to recognize and measure intangible assets. We have taught you how to impair assets. We have also talked about last week. We have talked about when we have leases. How do we deal with that? We have also addressed financial instruments. We have looked at accounting policies. We have looked at investment. We have learned a lot of standards. You see, the aim of all of these standards, it's towards preparation of financial statements, which hopefully I'll be able to demonstrate one or two prepare a full financial statement with some additional information. So, but for tonight, our focus is when we have a financial statement, you should be able to analyze and interpret. Your exam will always ask you that, either for 20 marks or for 15 marks, usually for 20 marks, at least in the past 2 or 3 nights. So when you want to analyze and interpret financial statements, there are many tools that are used to analyze and interpret financial statements, but the one that concerns us, the focus for your exam is ratios. Ratios are what we're going to use to analyze and interpret financial statements. And when we look at ratios, ratio analysis involves comparing one figure in the financial statement against another figure in the financial statement in order to make sense out of the two, because doing that would help bring out some strengths or weaknesses in the affairs of the company. For example, now, it's not just enough for you to look at revenue of a company in year 1, and you saw that the revenue in year 1 was 10,000 naira. And in year 2, you now saw that the revenue has increased from 10,000 to 12,000. You might be wrong if you judge that this company is doing well in terms of efficiency, in terms of improving its revenue. Yes, the revenue has increased in nominal terms, but for you to have a complete assessment, you need to back that analysis up with the resources that was put in year 2 to achieve that additional revenue, vis-a-vis the current resources they were using to achieve the revenue in year one. When you look at that, that will give you a complete picture of how efficient this company is in managing its resources, beyond just looking at the absolute figures and says that, okay, he has done so well in doing so much revenue, right? And that's what ratios will help us to do. And that will be the focus of tonight's class. So ratios. We're going to be looking at 5 categories of ratios tonight. The first one is profitability ratios, which you might find the examiner calling financial performance ratios. Then we have working capital ratios. This one, you will find your examiner calling this one efficiency ratios. You find them calling these efficiency ratios. We also have liquidity ratios. We have debt ratios, and we have investors ratios. What I want to teach you tonight is these ratios. As soon as we complete this tonight, then fine. What is left is just for you guys to attempt and solve past questions on your own. Then you'll be fine as far as ratios are concerned. Now, the first one, which is profitability ratios. You see, as the name implies, what these ratios will bring out for us is how profitable a company is. How profitable a company is. And the most important profitability ratio is ROCE, returns on capital employed. That's the most important profitability ratio. And in looking at returns on capital employed, there are majorly different, we can have different formulas for returns on capital employed, which is the first and most important profitability ratio. But the most popular formula that we have for returns on capital employed is this. We call it our profits all upon the capital employed multiplied by 100. Now, what these returns on capital employed will look out for us is for us to determine the amount of profit an entity was able to make, or an entity is able to make, from all the resources they put into the business. How much capital were we able to make from all our resources? Now, when calculating returns on capital employed, the major challenges we usually have, or the technicality we have, is looking at this formula for returns on capital employed, which is profits all upon capital employed multiplied by 100. The challenge is this: which profit are we going to use? Because when you check your statement of profit or loss, there are almost 4 categories of profit you can have there. Because there is gross profit, there is operating profit, which is also called your profit before interest and tax. There is your profit before tax. There is your profit after tax, which is also called the profit for the year. So which profits are we going to use? That's one issue that we have with this return on capital employed. Another one is the capital employed. The capital employed is the resources the entity has used to generate this profit. And when you check your statement of profit or loss, your capital employed could be your equity plus your debt, Could be your capital employed. It could be your equity plus your debt. Sometimes it could be just your equity alone. It could be just your equity alone. Because when you check the statement of financial position, assets, which is your total assets, is always equal to your equity, which is your share capital and reserves, plus your liabilities. Your statement of financial position, the total asset side, you will see that it will be equal to the equity plus liabilities. So when I'm teaching you capital employed, I always focus on the equity and liability side to determine capital employed. It's always easier that way. So your capital employed could be just your share capital and your reserves, which is your equity. Or it could be your equity plus your debt, usually your non-current liabilities. So which one are we going to use as capital employed? That's the major challenge. And how do we solve it? So listen up. The way to solve it is this. Usually, the examiner will give you a clue on which capital employed you are supposed to use. And your capital employed that you're using will then determine the profit you would use. So if the examiner tells you that the capital employed you should use should be your equity, which is your share capital plus your reserves, then the profit you are going to use will solely be the profit that is due to equity holders alone or shareholders alone. And the profit that is due to shareholders alone is either your profit before tax or profit for the year. It's either your profit before tax or profit, though your profit for the year is a more reliable measure since you have paid the government and paid everybody. So this profit for the year is seen as the profit that is owned or that is due to the ordinary shareholders. So if the capital employed you are using is just equity, which is your share capital plus reserves, then the profit you must use should be either PBT or PAT. PAT is what I'm calling profit for the year. If you go and use any other profit, you're very wrong. However, if your capital employed is your equity plus your liabilities, usually your non-current liabilities, which are the interest-bearing debts, like the loans and the ventures, if that is the capital employed you are using, then the profit you have to use would be either, in fact, must be the profit before interest and tax, PBIT, which we also call operating profit. That's if your capital employed is your equity plus your non-current liabilities. Now, that's the first technicality here, which is solved. So when you're determining, we'll see, they must match one another. The profit you use must match the capital employed. And don't forget, these returns on capital employed, as the name implies, will show us the amount of profit an entity is able to generate from its resources, from its financial resources. And of course, the higher the better. A company that is doing an higher ROCE is a superior company in terms of profitability. It's a superior company. And I did some demonstrations here. Now, another ratio that is very similar to returns on capital employed is returns on equity. They measure the same thing. They measure the same thing with ROCE. Is very similar to ROCE. The thing is just that this one has made the capital employed very specific. It has made it very clear. So returns on equity. So he strictly wants to know the return we are giving to our equity holders. Our equity holders. So which is our share capital plus our reserves. So of course, like I've explained to you earlier on, if the capital employed happens to be equity, then the profit must be profit after tax. So this is not surprising that we are having profit after tax over equity, right? So in the exam, you usually would prefer you to calculate ROCE, right? And you'll find that ROCE, the examiner would mostly tell you, mostly in most questions, you'll find that they will tell you that the capital employed is equity and debt and interest-bearing debt. They always tell you. That means the profit you must use in determining your ROCE must be PBIT, which is your profit before interest and PBIT. Now, there's another one which is profit margin. And profit margin is calculated as profit over sales multiplied by 100. The profit over sales multiplied by 100. This profit margin looks at the amount of profits that an entity makes on every 1 naira of sales. The amount of profit an entity makes on every 1 naira of sales. So every business person understands profit margin because you would know that everybody knows when they go to the market, especially those that are buying and selling. When you go to the market, you know how much you bought these items, you know your cost price, and you know how much you have to sell. So that profit you are putting on your cost price, I mean, if you express it in percentage, that is your profit margin. But in further studies, like those of you doing PM, then there will be distinguishing between markup and margin. So if you express that profit as a percentage of cost, it becomes markup. If you express that profit as a percentage of sales, it becomes margin. The focus here is sales, expressing the profit as a percentage of sales. That is the focus here for us. So the amount of profit you're making on every 1 naira of sales is your profit margin. So in the exam, usually you will see them calling this profit margin, they could call it gross profit margin. That's the common one you would find. So this profit will then be your gross profit. Or they call it operating profit margin. When they call it operating profit margin, that means you're going to use operating profit. But I've seen them often call it net profit, though they stopped recently. Net profit. So it's net, why you, I mean, when we see net profit, I wonder why did they call it net profit? Because right now, based on IAS 1 structural presentation of financial statement, you will not find any profit called net profit. So we then start argument, okay, which of this profit is net profit? Is it PBT? Is it PAT? Is it your BIT? It's always a challenge. So now, they are more specific. They either call it gross profit margin or operating profit margin. If they are silent, anyone you use, you're fine. Nobody will penalize you for whichever profit you use. Another profitability ratio is asset turnover. asset turnover. So from the name asset turnover, this is looking at how well or how efficient an entity is able to use its assets to generate sales. I mean, from the name, you turning your asset over is how many times you're able to use your assets to generate sales. Asset turnover. And of course, the higher the better, right? It shows that this company is efficient. If you're able to get a high asset turnover. So usually, we would see this profit margin and this asset turnover as a secondary ratio to ROCE. We see it as a secondary ratio to ROCE because they can help us explain ROCE. Let me see if I have the analysis somewhere here. Yes, I have it here. Yes. This profit margin and asset turnover will give you ROCE because I told you that your profit margin is profit over sales. The amount of profit you make on every sales, and your asset turnover, which is your sales all upon your capital employed, okay, which is your asset turnover. And again, if you look at the formula for this asset turnover, sales all upon capital employed. So usually in the exam, the capital employed you use for ROCE, the capital employed you use in calculating ROCE, just come and use the same one here to calculate asset turnover. That's the easiest way for you in your exam. So you see that sales can cancel out sales. Sales, since we're saying this multiplied by this, sales cancel out sales, then we are left with profit over capital employed, which demonstrates ROCE. And additionally, is that you see, ROCE and asset turnover is good that they are increasing. It shows that this company is profitable. But you find out that it's not possible for asset turnover to increase while profit margin is increasing as well. It's not usually possible. They are mutually exclusive. Not that they can't exist at the same time, but of course they can exist. What I'm saying is that they move in opposite direction. Because for you to have high profit margin, it's usually because you have high selling price. For you to make a lot of profits on every one area of your sales, is because your selling price was high. You added a lot of profit on the costs. So you are selling very high. And ECN 101, economics, when your selling price is very high, what happens to the quantity demanded? It decreases. It decreases, which is represented by asset turnover. Your asset turnover is usually demonstrated by volume of sales, which is how well you're able to convert your asset to sales. So if your selling price is too high, it will negatively impact the quantity sold, which would indicate a negative slope for your asset turnover, meaning your asset turnover will be low. So your profit margin and your asset turnover, they move in reverse direction. They cannot be increasing at the same time. So the two are profitability ratio. So profitability ratio we have, I've told you about ROCE, which you will always find in almost all your exams. There is a narrowed scope one, which is returns on equity, which is very similar to ROCE, but the examiner prefer to ask ROCE than this one. But if they are very specific, returns on equity, just give them this. Just ensure that your profit is right. If you get this one wrong, they will not permit you at all. Another one is profit margin, which is the amount of profit you make on every one of sales. There is asset turnover, which is how many times you're able to convert your assets into sales. Okay, so those are the profitability ratios that you would commonly have in the exam. Okay, any questions? There's somebody that drew a line on my board and the person left the line. Me, I cannot remove it. Any questions? Okay, so quickly, let me ask you a question. There was the examiner asked you guys, which I did not even talk about. I didn't talk about it with my students, but I know that they asked it and we did not teach them. Probably because even me myself, I've not really seen that ratio before, but they asked it anyways. They called it cost of sales ratio. Cost of sales ratio. So let's assume that I didn't teach you and you're in the exam hall and we have taught you, because cost of sales ratio is actually a profitability ratio. So how would you determine, what formula do you think you can use to get cost of sales ratio? Can you guess? And it was a compulsory question, so it was number one. Can anybody here try cost of sales ratio?
Okay, I would say sales over costs times 100. Because to get your sales, some cost must have gone into it. I don't know. I just feel that way. But I would have used sales over cost of sales.
Sales over cost of sales. Sales over cost of
I
sales rate.
think, sir,
Okay. Yeah, go ahead,
I
Joy.
think cost over sales times 100.
Okay. You are saying cost over sales times 100. Cost over
So,
sales. So
But
the
I
reverse.
okay.
Yeah, continue. please.
Cost of sales all over the net
Revenue.
sales times 100.
How about cost of sales over revenue times 100?
Oh, cost of sales over revenue times 100. Wow. Cost of sales ratio. Okay. So we have
Sir, I would say sales all over purchases times 100. Because it was purchases that generated sales.
okay, that's also reasonable. Sales over purchases. Okay, cost of sales ratio. Okay. So the guy that said, or the lady that said cost of sales over revenue seems to be correct.
Oh, wow.
Yeah.
so is sales not revenue?
Yes, sales is revenue.
Yeah, so don't know.
Oh, what did you say? You said sales over cost of sales now.
Yes, and someone said cost of sales over sales. Yes, I agree. But when you now laid emphasis on revenue, so I just wanted to confirm that sales and revenue are they not the same?
Yeah, the same. Yeah, the same.
Cost of the sales is actually different from sales itself.
Yes, yes. So yeah, so this is the ratio here. I think I have it here now. So the examiner called it cost of sales ratio. Okay, it's actually your cost of sales over sales. It's similar to your gross profit ratio. So since gross profit ratio or gross profit margin is gross profit over sales, then it's logical to say your cost of sales ratio is cost of sales over sales. That's except if the examiner is now specific on the particular ratio they want you to compare with. Then maybe they can say maybe your cost of sales to your assets. They can say your cost of sales to your receivables ratio, your cost of sales but now they are not specific. They just said cost of sales ratio. That was the only thing they said. So, I mean, the irrational thinker will look at, if I have my cost of sales, what can I possibly be comparing it with for me to know how profitable I am? It's two things, right? Is either you're comparing it with your gross profits or you're comparing it with your sales. Those are the two things you can compare your cost of sales with, because it's a top line item in itself. So the best of them is your sales, because that is the one that you are going to have available from your books. Your gross profit is a derivation. So your cost of sales ratio is looking at how much cost, okay, you incurred vis-a-vis your sales. How much cost you incur vis-a-vis your sales. So that diet, the examiner didn't even give us cost of sales. So all the examiner gave us was gross profit margin. The guy gave us our gross profit margin as 25%. So they now said, yeah, compute the cost of sales ratio. You don't even have to sweat. Your cost of sales ratio is 75%. Because if your gross profit margin is 25%, that means your cost was 75%. The cost of sales ratio was 75%. So, and that was the answer for that. And unfortunately, a lot of students didn't get it right for one reason or the other, and it was for 3 marks, cost of sales ratio. So they could express these questions in a lot of ways, and they are rational way to know what you would use to derive your formula in most instances. Okay. Now
Sorry,
let's
sir.
move.
Excuse me, sir.
Yes, Tosin.
Please, what if we were not giving cost of sales? We were not giving opening or closing inventory. We're only giving purchase. We're only giving purchases, and then there's the revenue and sales. Can we say purchases over sales? Oh,
Yes, you can. You can actually do that.
okay. All right.
Yes.
Thank you.
Okay. So don't forget that this cost of sales ratio, it's simply the same thing as 1 minus gross profit margin. It gives you the same answer, or you can express it cost of sales over sales, cost of sales ratio. Now, that is it for your profitability ratio. Again, before I move to this second one, if the examiner asks you that you should get the ratio of, calculate ratio of, they ask you to calculate wages to total expense ratio. Wages to total expense ratio, or maybe they express it fully, they call it salaries and wages to total expense ratio. How would you determine that? Salaries and wages to total expense ratio. How would you determine that?
Salaries and wages, the addition of both all over total expenses times 100.
Thank you very much. Okay, so that means you get the gist now. That's the idea. Okay.
But does that mean operating
the what?
expense?
I think
But he said that your salaries and wages all upon your total expense multiplied by 100.
okay.
Yes. Now, let's go to working capital ratios. So you won't find it as working capital ratios in the exam. You will mostly find it as efficiency ratios, because you will not find these other parts in your exam. Mostly, I mean, for the past so many years now, we don't find it. So I just have it in my notes, sharp. Let it just be there in case. So usually it's actually working capital ratios, and these working capital ratios, we could have working capital efficiency ratios. We could have working capital turnover ratios. Okay. But the emphasis have always been placed on efficiency ratios because that's the one that actually is indicative of meaningful relationships. So this turnover ratio is not really meaningful. When I show you, you will see. So this, again, so let me focus on these efficiency ratios, which is fully called working capital efficiency ratio. So in your exam, like I mentioned, you will see them calling it efficiency ratio. So please, there is nothing there. So the efficiency ratios are primarily three. We have trade receivables collection period. We have inventory turnover period. We have trade payables payment period. These are the three efficiency ratio you would give your examiner in the exam. And in some cases, that asset turnover under profitability ratio also perfectly fits into efficiency ratio, but let it just stay in its in its profitability ratio. Is okay there since it's a secondary ratio to ROCE. So we will take these three as working capital ratios. And I'm sure you're not surprised that you're finding these three as working capital ratio because trade receivables, inventory, and trade payables are, of course, the element of working capital we have. So they really coming up here as the working capital efficiency ratio is expected. So let's pick them one by one and analyze them. Let me start with the trade receivables collection period. Trade receivables collection period. So in your exam, okay, you can find the examiner call it trade receivables turnover period. I've seen the examiner call it debtors in days. I've seen the examiner call it trade receivables in days. They can call it any of them. Whether collect, in fact, I've seen them call it collection period. Whatever it is, look for trade receivables, collection, debtors, and that period or in days would tell you what you need to calculate. And you see, this ratio measures how many days or how long or the time it takes to collect money from our customers after sales has been made to them. How many days it takes you to collect your money back from your customer. That is your trade receivables in days. And it's usually computed as your trade receivables all upon your credit sales. Trade receivables all upon your credit sales would give you your collection period. And as far as this ratio is concerned, of course, the shorter, the better for an entity. An entity that has a short collection period is best because that means you are collecting your money early enough from your customers. So the shorter, the better for your trade receivables collection period. The second one, please don't write on my board again. Is inventory turnover period. Inventory turnover period. Okay, Temitope.
Yes, sir. The one we just finished looking at, it said the formula is trade receivable over credit sales. So to me, I feel trade receivable and credit sales, are they not the same? So I just wanted to understand because I feel like receivables and credit sales, they are the same.
Okay, yeah, they should be if we have not started collecting money from our receivables. So the idea is that some of them might have paid. So the receivable will
Okay.
be reduced. Yeah.
Okay, so the credit sales is the total credit sales. Then the trade receivable is what is left from the
Exactly.
sale. Okay.
Yes.
Thank you, sir.
So, but in the exam, you see, the examiner will not give you credit sales. They'll just give you sales. So just use your sales like that. Don't start looking for credit sales up and down.
Okay. Thank you, sir.
Yeah. Okay. So inventory turnover period. You see, this ratio measures the time, the days, the months, the year, right? That's an entity holds inventory before it then sells it to its customers. How long an entity holds its inventory before it sells it to its customers. That's inventory turnover period. And it is calculated as inventory all upon your cost of sales multiplied by 365 days. This is your inventory turnover period. So again, this inventory, use closing inventory. Don't, of course, you could use average if you want, but it's just easy and straightforward for you to use closing because you still get your full mark. You will never go wrong with using closing inventory. Straightforward and simple. So your closing inventory all upon cost of sales multiplied by 365 will give you the number of days. If you multiply it by 12 months, that will give you the number of months. But it's common that we use number of days. And you can guess, the shorter the better now, Abi. Sell early. If you are able to clear up your inventory early enough, it's good for you as an entity because you'll be able to then go back to the market and buy more goods. Okay, Olakunle.
Okay, sir. Still on the trade receivables collection period. Could it
Okay.
also be expressed as debtors all over credit sales?
Of course, yes.
Thank you.
Yes. But don't express it as that because you know that now we call debtors trade receivables. So you just call it trade receivables.
All right.
Yeah. So now, if an entity is having an elongated days for it to sell its inventory, it's not good because it's like it's tying down its working capital. It's not good for the entity. If your inventory period is elongated, it means you're unable to sell and you're building up inventory levels. It will show in your working capital and it will affect you as an entity. So if we combine trade receivable collection period, let's say our trade receivable collection period, let's say it's 50 days. Okay. And my inventory turnover period, let's say it's 20 days. So in summation, I have 70 days. Knowing fully well that trade receivable collection period means the number of days it takes to collect money from customer, while inventory turnover period means the number of days it takes to sell goods to customer. So what do you think that 70 days would represent? So that 70 days would be the number of days it takes for you to convert your inventory to cash. The number of days it takes to convert your inventory to cash. So since inventory turnover period is number of days it takes to sell, your trade receivable turnover period is number of days it takes to collect money from customers. So combination of the two is number of days it takes to convert inventory to cash. Then the last one here is trade payables turnover period, which looks at the number of days it takes to pay your supplier, how many days it takes to pay your supplier. And it's usually trade payables over credit purchases. Trade payables over credit purchases. In fact, this cost of sales, just that now you always find cost of sales in the exam. If you don't find it, we always advise that just use purchases, right? But of course, you always find cost of sales. The one you might not even find is this credit purchases. So you can use trade payables over cost of sales here. You can use trade payables over cost. Feel free to use trade payable over cost of sales instead of trying to compute your cost of sales or your credit purchases. Just use trade payable over your cost of sales. You're fine, except if the examiner specifically gives you these credit purchases. We would usually use trade payables over cost of sales multiplied by 100. Multiplied by 365 days. So the number of days it takes to pay our suppliers. If I may ask, is it the longer the better for this one or the shorter the better? For
The
your
longer,
trade.
the better.
The shorter.
The shorter, the better.
The longer, the better.
Okay. So, I mean, we have conflicting answers. So I just need two people. The longer the better justify, the shorter the better justify.
The
Yes,
longer
sir.
the better. The longer the better.
Okay, go ahead. Justify.
Hello, sir.
It gives you opportunity to sell your goods and then as well collect money from your customers. After that, you pay your suppliers as well.
Exactly.
Okay, are you justifying the longer the better?
Yes, the longer the better.
Okay, so you're
Correct.
saying
Yeah.
that it's good for you to be long. So you're saying that if a company A has a trade payables turnover period of 50 days and company B has 30 days, you're saying company A is a more efficient company.
Yeah,
Juliet.
I would want to use that for me to sell. I would want to because looking at it from a business perspective, I feel the longer the better.
Okay, okay, no problem.
Okay, I'm supporting the shorter the better.
All
And
right,
that's
let's just.
because the shorter the better, because it shows how well you're doing. Because if you can sell your goods and pay your supplier within a shorter period, it just shows how efficient you are and how well the business is moving. I don't know, from my own perspective.
Quite rational.
Well, I believe the longer is better in that if you're able to sell, you can trade with the money instead of financing elsewhere and later pay them.
Okay.
Okay, so just like she said, the longer the better, because
the better.
you can do business with the money and gain additional cash inflow, which is like a plus to the company.
Okay. All right. So I've had enough. So let me tell you mine. So for your exams, in fact, in your past questions, when you check point finders, at least for your level, even for the advanced levels, the guys that provide solution for that point finder, they are the school of thought of the longer the better. So you find them in their solution saying the longer the better, the longer the better. So of course, not bad, but if you put context to it, then you will see that the longer the better is not the right one. It's the shorter the better if you put it to appropriate context. So looking at it on the surface, for a management accountant or a performance manager, of course, what Ayola have said, and yes, and the others, they will say, okay, hold on to your supplier's money, use it to do business, delay his money. Right? Yes, it makes sense, make some money, provided that you are not exceeding the credit period. So the major determinant for that is that first, we must establish a credit period. You see, if that is silent, then the longer the better looks juicy. If they are silent around credit period, the longer the better looks juicy, because you can make some money by trading with that money. But of course, an elongated the payables turnover period might be an indication that a company is facing liquidity problem, especially when you compare it from year to year, or when you compare it with industry average. When you have an elongated payables period, in a sense that, why would you want to delay your supplier if you are really doing a lot of activities? Because you want to pay and collect more goods and sell, pay, collect more goods and sell. So for you not to pay your supplier, the interpretation for us is not that you are using it to do, you are using it to make like passive some passive income. The interpretation for us, it will be that you are using it to run your operating expenses. Probably you want to quickly pay salaries, you don't have money to pay salaries yet, so you just quickly use that money instead of paying the supplier. Okay, let's use this one to pay salaries. Then okay, you are trying to get some other money to pay your supplier. That is what an elongated payables in days would indicate. Furthermore, trade payables is a capital. Yes, it is a capital, because somebody has given you goods on credit and say sell. When you sell, give me money. That's capital. So when you sell, then pay the person now. Why are you delaying his money? Why are you using it to do business again? Pay him and collect another set of goods. Because if you pay early, the guy would want to give you more credit period. More credit period. Okay, so I'm putting context to it. I am painting it, right? So for your exams, let me narrow it now. For your exam, if you see two companies having longer, the one that is having longer, if you are supporting longer, yes, justify it. And all of you justified it well. So you get your mark that, okay, this guy is having a longer period because he can use the money to trade. I don't want that one. I don't want you to write that one in the exam because he can use the money to trade. No, that means you have liquidity problem. Go and use another money to trade now, right? Why are you using your supplier's money to trade? If you are saying that the reason, your justification for longer period, if you are the longer period perspective, your justification should be that, okay, this guy has a longer turnover period because he's creditworthy, and over time he has shown his supplier that he will pay early, which is why they are allowing him a longer period. That shows that, okay, this company is efficient. But me, I'm a school of thought of shorter period, meaning that this company pays his suppliers early enough, and doing that will make him creditworthy, and they will extend him extended credit term or extended credit period. So either school of thought is right. Just explain why you think a longer is better, or explain to us why you think shorter is better. But for me, Because by the time, at least, reason why I'm saying for me, because by the time we look at it, even deep down, shorter is better. When we look at it in-depthly, suppliers' money is not money you are supposed to be using to do business. Is money you pay to the supplier immediately, right? Not using it to make passive income or whatever. Okay, so that is efficiency ratio. They are just those three, your receivables collection period, inventory turnover period, and your trade payables turnover period. Now, if you combine your trade receivables in days, let's assume it's 10 days, with your inventory in days, let's assume it's 12 days. I told you that this 22 days means the number of days it takes you to convert your inventory to cash. If your trade payables in days is now 14, which is the number of days it will take you to pay your suppliers. You see, by the time you take 22 or 14 from 22, what you have left is 8 days. These 8 days, we call it operating cycle. Sometimes the examiner will call it cash cycle. Sometimes they call it trading cycle. Sometimes they call it conversion cycle. And sometimes they call it working capital cycle. Note all of those names. They can ask you to compute it for 8 marks, for 7 marks, or for 9 marks. They have done that in the past before. Is your trade receivables in days plus your inventory in days minus the paying back, which is trade payables in days, will give you your operating cycle. You see, operating is a major determinant for efficiency, because according to IAS 1, what I taught you when we're starting this class, this diet, I said operating cycle is the period or is the number of days or number of months between when you start a transaction and end a transaction. How long it takes you to start and end, the duration. Of course, I need not tell you that the shorter, the better. The shorter, the better. Start and end a transaction early. So you know that you're done with this transaction, you move to the next one, you move to the next one, you move to the next one. Then you're creating wealth as an entity. So the shorter, the better for entity. You see, an entity that is having an elongated operating cycle is not good, it's bad. And it's usually an indication of two things. Number one is an indication that this company is overtrading, or an indication that this company is overcapitalized. When you have an elongated operating cycle, is either you are overtrading or you're overcapitalized. What do they mean? What is overtrading? What is overcapitalization? Let me start with overtrading, which is the one you find in the exam. So I will paint a scenario for you for overtrading. I'll actually paint two scenarios. Number one, let's say an entity has a capital of 20 million naira. And this capital can start him up with 10,000 units. He can buy maybe 10,000 units of bottles to sell, or 10,000 units of bags, whatever that he's selling, he can do 10,000 units. That is the capacity of his 20 million. But this company, or this my guy, believes that he can do 100,000 units, even though his capital can only accommodate 10,000, remember? But he believes he can do 100,000. That's his intended capacity. The funny thing is that he was able to do it. he was able to achieve it. He achieved the 100,000. How did he do it? Number one, he will have borrowed from banks, from friends, from families, because this 20 million capital is not enough. 20 million can only 10,000. So he will have borrowed. If you see his balance sheet, you will see that between that current year and the previous year, you see a dramatic upshift in long-term loans, in borrowings. You see that it would jump up drastically. Number two, you will see that this guy will have acquired new PPE to accommodate that his intended capacity, which his resources cannot accommodate. But he wants to do it. He did it. He will have acquired a lot of PPE. If you check within the years, you will see that his PPE will have sharply increased. Sharply. Maybe his PPE last year was 20 million. This year will have jumped to like almost 80 million. It will increase sharply. Number three is that you have huge trade payables. See, he doesn't have the capital. He doesn't. So most of his resources, his raw materials, he would have bought them on credit. He doesn't have the capital to support that 100,000 he wants to do. He will buy on credit. Unfortunately for him, his trade receivables will now be huge because he's going to have high inventory levels. He will want to sell. And because he's desperate to sell, you see him giving favorable credit terms. People will buy, but they won't pay. They won't pay on time. So his trade receivables will be huge. And of course, you'll see a very sharp increase in sales. And of course, his cash position will be negative. He won't have cash. He has invested everything. You see, all this, when you look at a balance sheet of a typical company, you can easily spot that this company has overtraded. His borrowing is so high, he purchased huge PPE, his payables is so high, receivables is so high, inventory level so high, negative cash balance, sharp increase in sales. I mean, unfortunately for him, that sharp increase in sales, even though it's not backed up by cash flow, will now trickle down to profits because his profit will now look big. Government will now come and meet him and say, you should pay huge tax. His tax will increase. He will be paying interest to finance these borrowings and bank overdraft. His finance cost will increase as well. Yeah. I mean, this is just similar to somebody that is like an ICANN student that is very busy. He works Monday to Friday, goes to class, very busy, doesn't have so much time, but wants to write 6 papers at skills level. That's overtrading. Funny enough, you see them passing, but you will have a lot of stress.
This economy.
Now, how do you then solve this? How do you get out of this mess? How do you get out of this mess? Number one, you see, go and meet these people because you have already borrowed. Go and meet them and see if you could restructure these loans. Whether they could help you reduce the rate of interest, maybe they can help you extend the period. I mean, restructure the loan. 2, all these assets you have bought, sell some of them. Sell some of them. Meet these trade payables and see if they can also extend additional credits. Explain to them and see. let them know that you have huge trade receivables. And these trade receivables, the best bet for him is to get the service of a factor. A factor is an agent that helps recover debts. So get the service of a factor, pay him some commission, let him pursue these guys. Find a way to get your money. Then these other ones, there's nothing you can do about them. Another one, importantly, is for you to raise additional capital if possible. Inject capital into the business. For me, if I see a business like this, I would want to inject money. I mean, the guy is a go-getter. He was able to increase his sales. He was able to sell. I mean, he just need proper capital so that it will sell to the right people.
Loan capital or equity capital?
Equity capital. It can't be loan capital because the guy already has huge loans already. His borrowings are huge. He's still speaking to these guys to restructure. So he cannot get additional capital, additional loan capital. He will inject equity capital into the business. Okay, you see, I can has actually asked you this scenario I've just given you before for 10 marks. Yeah, 15 marks. It was a 15 marks question that died. I will show you. 15 marks question. Let me see. One of your past questions that died. 15 marks. But the analysis I've given to you can only just help you to not forget blockchain. That's what I'll be teaching you next week. Blockchain technology. Where is it? Okay. Okay, so look at it. That was, which year is this? This 2020. They said, discuss 3 signs which shows that Ikoko is suffering from overtrading during the year. Identify 5 possible causes from the financial statement. Recommend 5 possible solutions. 50 marks. And if you look at it, all those things I've mentioned is there. Look at the guy. In 2013, his revenue was 20 million. In 2014, look at the sharp increase in sales. Have you seen it? Look at the interest expense. In 2013, it was 0. In 2014, it's 10 million. Have you seen it? Look at his tax. 2 million. In 2014, 60 million. Look at it. Go and check his bank position. Look at it. It's in negative. It was in positive in 2013 because of that overtrading. See his bank position, bank overdraft. See his PPE.
See assets.
Yeah, look at it. See his inventory levels.
Increased.
Look at it. See his trade payable.
Yay.
Look at it. So it's a very straightforward question, and everything indicates, and just get 15 marks. You can look at this question later, but that was the question for 2020. 15 marks, easy, straightforward. Easy, straightforward. But what could be the possible solution for the person that has no time and wants to write 6 papers now?
The person should start reading on time.
Is this my fault?
You should go ahead.
Drop one.
The person should start reading on time.
It's not my fault now. You split it.
You
my
should,
fault.
you should go ahead with it, sir. And after exam, you can go and take injection and other treatment.
And the economy is not even encouraging.
So the funny thing was that there was one of my students that when I was teaching them this particular subject, so she wanted to write skills. She wanted to write 6 papers, and I gave this example for overtrading. She was looking at me. Unfortunately, unfortunately for me, no, she passed. She now passed all the papers.
Yeah.
She now came to professional. I was not using the same example again. She said no. She was not telling anybody in class that Mr. Masu, I don't know why you're discouraging people. That was the same example you used when I was in skills and I passed. I was ashamed. I said, what is this? I just actually moved on. I mean, whether you have time or not, it doesn't really. It's not actually a good example. I need to stop using it. So if you can actually manage your time, you can write 6 papers and pass, or whatever it is, that's the case. Okay. We are done with efficiency ratios. So this is the other one ICAN does not ask. Still under working capital, but this one is turnover ratios. So it's just the reciprocal of efficiency ratio. If you look at this trade receivable turnover, is the reciprocal of trade receivable turnover period. When I say reciprocal, it's like they switch over the denominator and the numerator. This one is now credit sales over trade receivables. Unlike the other one, the receivables in days, which was trade receivables over credit sales. So, I mean, it's switched. So the same thing as inventory turnover, the same thing is the reciprocal of inventory turnover period. Trade payables turnover is the reciprocal of trade payables turnover period. So, I mean, that was what I wrote. But the thing why ICAN will not even ask you is, it's not indicative of a lot of things. It's not indicative of, because it's a bit difficult to interpret. I don't even know what this means. Trade receivable turnover, or is there anybody that can interpret this particular one for us? Or trade payables turnover? It doesn't really indicate anything. The only one that makes sense is this inventory turnover, which is how many times you're able to turn over your inventory. I mean, how many times you're able to, that one to self, when you say how many times, is it the number of times people are buying, or what do you mean by how many times you're able to turn over your inventory? So, but we use this one seldomly, but these other ones, you won't find them in the exam like that. Okay, so focus on the efficiency ratio, understand the operating cycle, and understand over trading from the scenario I gave to you, then you'll be fine for efficiency ratios. Okay, we are getting there. Then the next one is liquidity ratios. Liquidity ratios. So in reporting, liquidity means cash and highly short-term investments. So liquidity is not just cash, it includes near cash, which IS7 also calls cash equivalent. Okay, so when we say how liquid, this ratio will really look at how liquid a company is. So it's not just looking at its bank and cash balances, it's also looking at its other assets that it can quickly convert to cash as well. Those are liquid assets. Okay, so there are two liquidity ratio. We have current ratio and the quick ratio. The quick ratio is also called acid test ratio. So the current ratio is current asset over current liabilities, which really shows whether a company has enough liquid assets or short-term assets to settle its short-term obligations. Do you have short-term assets to settle your short-term obligations? So usually you will find that they will tell you that this current asset should be at least 2. It should be at least twice of this one. But The most important measure is for you to be able to compare with your previous year and with other companies or with industry average. For you to know whether you're doing well or not is by looking at, okay, what's the industry doing? If the industry is doing 3-1 and you are doing 2-1, you need to improve. Because when investors come, they will rather go and invest in other companies that are more liquid rather than come to you. Furthermore, you also need to compare with previous years, which is how your exam will come. You would always compare, usually to know whether the ratios are good or bad. You need to compare it with a standpoint, with a basis. And this ratio, the higher they are, the better. And another better ratio for quick ratio or acid test ratio is or for liquidity ratio generally is quick or acid test ratio, because this one considers even more liquid assets, because it will have removed assets that we consider not to be so liquid, and popularly we would remove inventory. That does not mean that we cannot remove other items that the examiner wants you to remove. The examiner could tell you that maybe prepayment is seen as non-liquid. When they tell you that, that means you would also remove prepayment as well, or any other assets that they feel is non-liquid. Because the aim of quick ratio or acid test ratio is for you to look at, do we have highly liquid assets that can settle our highly short-term liabilities? That's the aim of quick ratio. Okay, and of course, for this also, the higher the better. The higher, the more assets you have, the more cover you have, the better. Okay, Temitope, go ahead.
Yes, sir. I just want to understand the concept behind saying inventory is not so liquid, because I feel like they are the goods you have at hand. Even you can decide to even sell at discount and make money or something. I just feel like I just want to understand why they would say it's not so liquid, because I'm not getting it right.
Yes, so because for us, liquid is something which you have control over, that you can immediately if you need cash today, you get cash today. That's what we mean by liquid. So inventory, if you need cash today, inventory cannot necessarily convert to cash today. Not necessarily, right? It takes a lot of effort to get somebody to actually buy. You might not get somebody to buy. People put in a lot of effort to get people buy their inventories. Why? I mean, you could use your inventory to borrow money from the bank, but you know the documentation and processes you will take. So the aim of this ratio is saying that, okay, if this guy come today, can we rally around between today, tomorrow, and get money to pay them? That's the idea of quick ratio. So, I mean, popularly, and generally, inventory is seen not to be that, which is true.
Okay.
But even a better ratio, okay, yeah, I have it here, is cash flow ratio. Let me add it because I didn't add it here initially. Cash flow ratio. So cash flow ratio just puts your, okay, let's just focus on the cash, on your current liabilities. This, okay, cash, like how much cash do we have and cash equivalents all upon our current liabilities. This is the best measure for liquidity. That means you don't even have to run around. You don't have to call anybody. Cash is there. When the guy comes, give me your account number. The only question you're asking the guy is not, okay, when did I sell? The only question you're asking the guy is how much. He comes, your next question is how much? Give me your account number. You transfer the money. That's what this looks at. Do you have the cash on ground that if any liability comes, you settle? And of course, the higher the better. The higher this ratio, the better. So that's the cash flow ratio. And there are some sample ratios I use hypothetical figure to compute here. Like this guy for current ratio, 1.24 to 1 to 1.13 to 1. So here 2017 is better. For quick ratio, 1.17 to 1 to 1.03 to 1. Of course, 2017 is better like that. So the higher, the better. So that is liquidity ratio. So that one also, you have learned 3 ratios: current ratio, quick ratio, cash flow ratio. Now, the next one is debt ratio. So this ratio, seldomly they call it stability ratio. And majorly, we use it to measure the going concern of a company, or we use it to understand whether a company has a lot of debt in its capital structure or in its financing. We also, basically, we use it to look at how exposed is this guy? What's the possibility of his going concern? Does he have any debt issue? You would understand the component of debt he has in his capital structure with this ratio, debt ratio. So there are 4 of them. There is the debt ratio itself, there is the gearing ratio, there is the interest cover, and there is the cash flow ratio. So the debt ratio itself is total debt to total assets. Okay, you'll find the examiner calling this debt to asset ratio. So, and it's just your total debt. Usually you would use your current and your non-current liabilities. You can simply ignore deferred tax, because deferred tax is just an accounting measure. It doesn't really measure any debts or what have you. So total debt and your total assets, just use your current plus your non-current assets. You get your debt ratio. Like here now, you see that this guy's debt ratio is lower, which is the lower the better for debt ratio. The lower the better. Because when you have, is like, this considers the proportion of your assets that is financed with debts, right? The second one, which is gearing or leverage ratio, this one is very popular, is, again, they call this one debt to equity ratio. Debt to equity ratio. So we also call it leverage ratio. Okay, so it majorly looks at the debt that is present in your capital structure. Debt that is, and this debt you're talking about is not short-term debt, but long-term debt. And that's why the formula is your interest-bearing debt. So when I say interest-bearing debt, I'm talking about those non-current liabilities that you find interest behind them, that they will say 10% loan notes, 15% debenture, 17% preference shares. All of those are interest-bearing debts. All upon interest-bearing debt plus equity, or it could just be the debt to equity itself. So when you have ratios like this, of course, the lower the better for any entity. When it comes to looking at the proportion of your capital structure that is debt, the lower the better. And what is lower? So lower is 50%. That's if you are using ratio 1, if you are using this formula 1. When the ratio you get goes beyond 50%, then we say you are highly geared. So since this one is looking at the debt in your entire, all upon your entire capital structure. So if it is higher than 50%, then you are highly geared. That is bad. This one, when you're just comparing your debt to equity, is high when the ratio you get here is over 100%. It's too high. That means you're highly geared. And the problem of being highly geared is a problem of financial risk. Financial risk. And when we say financial risk, is the risk attributable to borrowing money. And there are two of them. Two. Number one is that the risk that you might not be able to pay interest and principal as and when due. And because it's a financial liability, if you remember, which gives you a contractual obligation to deliver cash. If you don't deliver, it's contractual. They can bankrupt the company. They can put the company under receivership and say, this guy doesn't have the ability to pay anymore. Let's put him on receivership. They will shut down your company. That's a financial risk. Risk that you might not meet up with interest and principal. That's one. Financial risk is also the risk that you might not be able to pay sufficient dividend to ordinary shareholders as a result of excessive payment of interest. Because when you have huge debt in your capital structure, it means you're going to be paying huge finance costs as well. And it's fixed. You pay it every year. If you are not able to pay, it's a problem. So you must pay. So when it becomes excessive, it will affect your profits, which will in turn affect the dividend you pay to your shareholders. And when you're not paying dividend to your shareholders, it can affect your share price. It can affect your share price. That is the normal flow. That's the a priori expectation. But of course, practically, it doesn't really follow. I mean, if you look at companies like Amazon, the guy used to brag about it, that they have never paid dividends to their shareholders. They didn't pay dividend for over a decade, but they were worth billions of dollars. I mean, the guy was able to express the vision of the company and sell it properly. Not all CEOs will be like Jeff. The ones that are not, I mean, if shareholders don't get dividend, they will sell your shares. They will just sell the company's shares and go and buy another shares in company. And by the time sell becomes excessive, the share price of the company will dip. It will fall. So financial risk, those are the issues with gearing ratio or leverage ratio. So the examiner usually will tell you which of these ratios to use because either of them will fly. Okay, so they will tell you which of them to use. Now they will tell you that, okay, for gearing ratio, use the capital structure as debt plus equity, or they will tell you the entire formula you should use. So the key thing you should remember is that these debts in question are interest-bearing debt. So don't go and be using items like provisions, items like deferred tax. No, don't use those ones. Don't consider them as part of your debt. Right? Our consideration are debt that you actually are going to pay back to the counterparty. Okay, so that's that. Then we have interest cover ratio, which is how many times your profit can pay your interests. Okay, how many times your profit can pay your interests. Of course, this one, the higher the better. The higher the better because it shows cover. It shows that even if you pay a lot of interest, your shareholders will not suffer. This is what interest cover ratio does for any company. Your shareholders will not suffer. So for you to know the effect of gearing on a company, go and complete interest cover ratio and see that is it making enough profit that can cover that excessive interest. So a convenient position is just we understanding the industry average, or at least 6 times. Popularly, we say 6 times. Or in this book, I said 3 times. It's fine. It's fine, but the more the better. The more the better. While cash flow ratio is just, okay, do we have enough cash to settle our debts? I mean, this ultimately says it all. for a company with high gearing ratio, put the cash on those debts and see, does he have enough cash to settle them? Even though they are long-term debts, but I mean, it's a show of strength to see the availability of cash on your debt. And this cash in question is not necessarily the cash in your bank. We would be more interested in your cash from your operating activities, because cash in your bank can be misleading, because inclusive in there will be even the cash you borrowed from those people. So you cannot now be putting that on the total debt, but rather you look at, okay, what cash have you actually generated from your activities? You put that on the debt. Let's see the percentage. Of course, the higher the better for this ratio too. The higher the better for us. So finally is investors' ratios. So investors' ratios are majorly will be applicable for companies that are quoted, or for investors that want to invest in a quoted entity. They would be more interested in companies' investors' ratios. So we have dividend per share, we have earnings per share, we have dividend cover, we have price earning ratio, we have dividend yield, and many more. Okay, I've seen I've seen them talk about dividend payout ratio. I've seen them, they have actually talk about net asset per share, and a lot more like that, which hopefully we'll look at very soon. So there is earnings per share. As the name implies, the amount of earnings that is due or payable to each ordinary shares, earnings per share, and is computed as profit attributable to ordinary shares over number of ordinary shares. I know that you have been taught this one, some of you, as a separate topic. So earnings per share majorly focuses on the ordinary shareholders. So in fact, it's because of this ratio that profit on equity I told you, that second ratio I told you on that profitability ratio has become irrelevant, because earnings per share is a better measure than returns on equity. So earnings per share is just the best. So we use the profit attributable to just ordinary shares all upon the number of ordinary shares. Of course, the higher the better. Okay, the higher the better. So aside earnings per share, of course, there is earnings yield. There is earnings yield, something we call earnings yield. And earnings yield looks at the actual returns by comparing these earnings per share to market price per share. By comparing earnings per share to market price per share. This gives us the actual returns to ordinary shareholders. Because it's not just enough for you to say, okay, in year, let's say company A is giving earnings per share of 2 naira, and company B is giving 4 naira. Company A is giving 2 naira, company B is giving 4 naira. Of course, in terms of earnings per share, of course, we'll be quick to say that company B is better because it's giving 4 naira. But have you considered how much they paid for those shares to earn that 2 naira and 4 naira? If that guy that is getting 4 naira as earnings per share, if he had bought those shares per share for 4 naira, that means his actual return is like 100%. But if the guy that is getting 2 naira bought those shares for 1 naira, that's 200%. That's what earnings yield does for us. It shows us the actual return on these earnings. So another one very similar to earnings per share is dividend per share. So instead of using profits, we use dividend payable all upon number of ordinary shares. And of course, there's also dividend yield, just similar to the analysis I gave you for earnings yield, which is earnings per share over the market price per share. Earnings per share over the market price per share. This gives the actual return to shareholders, because it considers how much are you even paying to get dividend. Then there's another one, which is dividend cover, which is how many times your profit can pay your dividend. Okay. How many times your profit can pay your dividend. Sometimes you see it as EPS over DPS as your dividend cover. Then we have price earning ratio. So price earning ratio, as the name implies, price earnings. So is your market price over earnings per share. Price earnings, market price over earnings per share. So usually this ratio would measure the value or confidence that the market has in a company. A company that has high PE ratio means that investors believe that they are confident in this company. And even though this company is not paying us any earnings now, we are ready to wait till when these guys start making good money. Then we are ready to wait for as long as possible. Because for you to have high PE ratio, it means that your earnings are small and your market price is still high. That is anti-intuitive. Why would your earnings be small and market price be high? Because that's the only way you can have huge price earning ratio. A company that you see having high price earning ratio, you should be sure that this company will probably be a tech startup, or probably this company is a company that is not making so much revenue, but is worth billions, because the market believes that they will do well. Like a company like Tesla, for example, now is worth much more than other automakers like Toyota and Benz and those other ones that has been in existence since forever. But because this guy has found a way of making money after you have even bought the car, because there are a lot of subscription service you're going to be paying on those cars, unlike when you buy a Toyota or a Benz car, when you buy one off, you have bought it. You cannot continue to make money from that customer. The people that will be making money are other counterparties, suppliers, mechanics, spare parts sellers, and all of that. But there's a way Tesla has tied the user to its software and will continue to make money from them, because there'll be upgrades, there will be all of that. So that's price earning ratio. It shows the confidence that the market has in a company and its future. What again? I've mentioned dividend yield. So there is dividend payouts, which is the proportion of the proportion of your earnings that you are paying out as dividend is usually expressed as DPS over EPS. And there is dividend retention, which is the proportion of your earnings that you are retaining. Sometimes you can have this one as your retained earnings all upon your profit for the year, or your EPS minus DPS all upon your EPS. Okay, so those are all the ratios that you would need to know for your exam. Any questions before I round up? Prudence, do you want to ask a question? I am mute. Okay. Now, on a final note, before I let you guys go, it's been long they ask this one, but you might want to learn a little about it. Just know that these ratios has limitations. Learn about the limitation of these ratios. At least know 2 or 3 of them. And maybe this one might not concern you, limitation of financial statements, but it's not bad reading it through as well. You might learn 1 or 2 things from it. Analysis of cash flows. This doesn't concern you. It concerns the professional students more. Okay, so these are past questions that, I mean, they ask it every night. So, and all that, all the examiner wants you to be able to do is to compute and do very simple analysis, very, very simple analysis. So in most of these ratio questions, you've seen them asking you to compute some ratios, draft a report, and advising and all of that. So, I mean, that's where analysis actually come up. Okay, this was the diet they asked, a cost of sales ratio. Yeah, and earnings yield. This is cost of sales ratio I was talking about. That they say they should compute, and they didn't even give them cost of sales. So they didn't give him sales, they didn't give him cost of sales, but they gave us, I think we have gross profit margin. So 1 minus gross profit margin will give you your answer that diet. Okay. So of course, in this particular diet, they didn't even ask them to compute any ratio. They wanted them to analyze, interpret, and very straightforward to analyze these ratios. It's just for you to tell them what it means. That's one. And also for you to tell them whether the higher the better, the lower the better, comparing it with another company. Like this one now, they want you to advise whether they should buy Worry. So that means you'll be comparing Worry with the industry. You can't be comparing Worry with yourself. You'll be entirely wrong because you are Worry. You are the company that wants to buy Worry. So you'll be comparing Worry with industry. So here now, I'll tell them, gross profit margin, this ratio looks at the amount of gross profit a company makes on every ₦1 of sales. And Worry has 38.5%, which is higher than the industry average. This shows that this company is more profitable than most companies in the industry. You have analyzed it. You go to expenses margin, which is my expenses on my sales. Okay. So how much of my sales am I spending as expenses? So Worry is doing just 5%. Industry is doing 15%. Worry is better, right? Net profit after tax margin. So which is my net profit, my profit after tax over sales. How much of my sales am I able to convert to profit, or the net profit on every ₦1 of sales? And this guy is doing 9%, while the industry is doing 20%. So this is not good enough because it's lower than the industry. And this will be because maybe the company is not managing his operating expenses very well, making his profit after tax to be small, like that. If you look at this current ratio now, current ratio is liquidity ratio, and I told you the higher the better. And I told you that is the availability of liquid assets, highly short-term assets to settle highly short-term liabilities. For these two, they mean the same thing, just that this quick ratio consider even more liquid assets. And in the two situations, the guy is doing better than the industry. Just that in your exam, you pick them one, there's no need to rush you because you are fighting for 13 marks. You pick them one by one. You do small analysis. You tell them, okay, gross profit margin. You see, when one by one. When you get to current ratio, this ratio looks at the availability of available current asset to settle early short-term investment, to settle early short-term liabilities, and the Warri is doing 5-1, while the industry is doing 2-1. It shows that Warri is doing better than the industry. Finish. You do the same thing for quick ratio, it's doing better than the industry. You do the same thing for debt to equity ratio. This guy is highly geared. Not well, debt equity ratio, highly geared points will be 100% and above, since it's just debt equity, but he has more debt than industry. Having too much debt exposes you to financial risk. And if you look at it, he has problem already. He doesn't have available profit to cover the interest. Just 0.05 times, where industry is doing 8 times. And there's problem. Yeah, this company is good in terms of profitability, even though he's not managing his expenses well. His liquidity is good, but his stability is risky. And when you consider his earnings, it's also not bad. His earnings is also not bad. So, and they want you to advise. You see, out of these 13 marks, by the time you pick all of these one by one and explain it, analyze it, short explanation. Don't write an epistle. Short explanation on each of them. You will have gotten almost 9 marks. Of course, you have to conclude that, okay, generally, the company is more profitable, but is not managing its expenses well, which shows in its net profit after tax margin. The company is liquid. However, this company is exposed to a high level of debt in its capital structure, and it doesn't have sufficient profit to cover the interest, which is risky. And also, his earnings are good. So I would advise, you can advise, it depends on you. There's no advice that is wrong or right. Just tell us why. I would advise that they should buy this company if they are ready to inject more capital to it. Because they have to inject capital because of these debts. And they're not even making more profits to cover it. So just inject capital so that if we can pay off some of the debts, then this company will be fine. So buy them. Buy it. In fact, they need money. That's why they are looking for potential acquirer anyways. So that is how you answer most of this question. The same thing here, they gave you all the ratios and they want you to analyze. They want you to write a report. And when the examiner says write a report, please, all you just need to do is just to say from to subject and date. Then just compute your ratios. And however you want to do it, you can pick them one by one and be speaking about them. Don't short notes, just for the examiner to see that, okay, this guy understand what he's talking about. This guy understand what he's talking about. And you find them even asking you that, what are the areas we think we should investigate? Yes, there are some, all these ones, my majorly include looking at some qualitative factors, some qualitative factors, or there are instances where you would need to explain further, like, okay, why did their gross profit margin decline? Why did their net profit decline? Probably because the expenses, they are not managing it. Probably because maybe they have high gearing ratio resulting in resulting in higher interests also. And a lot of areas that you can invest. You might want to even know, okay, how are they even able to, or do they have sufficient cash to settle these people if they come in ultimately? A lot of areas that you can bring in that you can tell them to investigate further. But these are the ways you would analyze most of these ratios in the exam. And if you look at this one, okay, this was the one of over trading and I was talking about. And this other one. Okay, Temitope, can go ahead.
Yes, sir. The question we just finished looking at now, is it that there's no calculation required at all? Is everything just about advice? Are we not going to calculate anything?
Yes, sir. Don't calculate anything, no. The examiner didn't ask you to calculate, though. Except this particular diet now, because I know you like calculation, Temitope. So this one is when you calculate.
Hey.
If they say write a report, don't calculate, oh. Write a report, new. So if they want you to calculate, they will tell you, like this one now, they said, calculate the above ratios for 1 year. So they gave you ratios for a company. They now want you to calculate the same ratio for another company. And I guess you already know all of this. So I don't need to be, you have all the ratios in your text. You see, I was telling you about, we'll see the other time, I was telling you that the examiner will always give you capital employed. So they gave us the capital employed as equity and loan notes. If I may ask, what are you going to use as your profit? That will be your
PBIT.
Profit before interest and tax.
interest and tax. So, okay, next week I think I'll be teaching you this blockchain technology and all of this. And I think I have IAS 20 and IAS 23 that I've not taught you. So
Hello,
I'll probably
sir.
teach you that next week. Yeah.
Yeah, for the one that has calculation, are you not going to take us through it at all? I mean, at least let us solve one and see how it is.
That is necessary.
Let's look at this one, for example. So they want us to calculate all of these ratios. Like this, we'll see, for example, now, they already told us that the capital employed is equity and loan notes. So they have given us the financial statement of 1 year. So we'll see is your profits all upon the capital employed. And since the examiner said use capital employed as your equity and loan notes, so that means in 2019 for 1 year, because they gave us financial statement of 1 year, I will get what is my equity. My equity is 36 plus 3938. So how much is that? Can you add that?
7568. 72538.
Okay. So I said we are using PBIT over equity plus loan notes. So we have gotten the equity as what? 7 what?
7538.
7538.
38. And they gave us our loan notes as 27. So if you add 27 to it,
10238.
sorry?
10238.
Okay, that was 10,238. Okay, so what's our PBIT?
For 2019.
For 2019, what's our PBIT? So additional information, the profit before tax is after charging depreciation, interest on loan, interest on bank overdrafts, and audit fees. So they have already deducted all of this from this 1440. So I want, so all I just need to do is just to probably add back my interest
Yes.
to this so that I can get my profit before the deducted interest. So just help me add 1440 plus
270,
plus 41.
270, 41, 1, 3,
How much is that?
1751.
1751.
Yes, 1751.
So times 100. So how much is that?
Sorry, the 27. Where? How did you get it? I didn't follow. Where?
Oh, that's the loan capital.
Okay, loan done. Yeah.
This 27.
7. Where? I cancelled. Okay. Yes. Yes. Yes.
This is the loan capital.
Yes. I've seen it. Okay.
So what will you get here?
17.10.
175.
Eh? 175%. Is that what you said?
No,
No.
it's 17.10. That's 17%.
Okay, that's 17%. Okay. All right, so that one makes sense. So you can do same thing for 2020. So that's for we'll see. So again, you will see that the examiner will mostly tell us what the capital employed will be. And it's just for you to pick to know what equity means, to know what loan note means for your exam. So net profit margin now. What will be your net profit margin? So I told you that this is what ICANN used to do in the past, but now they have changed. They always tell us which net profit exactly. So when they fail to tell us, we usually use net profit over sales as our net profit margin. We will use and the net profit, we will define it as PBIT. So I'm doing 2019, I'll just allow you to do 2020. So since my PBIT, I've already computed it up here as 1751. So 175. So I will just go and check my sales in my PLL. And what's my sales? 43875. Abi?
Yes, 43875. Yes.
43875. So times 100, that's what?
3.99.
That's 3.99.
104%. Yes. 3.99.
3.99, yes.
Yeah, so that's 3.99. So that's my net profit margin. Then I have my gross profit margin. So who can tell me what's the formula for gross profit margin?
Gross profit.
That's gross profit over sales.
That's my gross profit. All upon your what?
Sales.
All upon your skills. So I already know what my sales is from up here. Is 43875, Abi?
Yes.
But what's my gross profit?
Sure.
In 2019.
440.
How did you get it?
Revenue minus cost of sales.
It's not 1440. Check it again.
Oh, I didn't say. 13162.
13162.
162.
Okay. So what do you have?
99.9. Let's say 30%.
Yes, 30.
That's yes.
Yeah, 30%.
Okay. So that's gross profit margin. How about this asset turnover?
Asset turnover is sales over capital employed.
Correct. Sales over capital. So you don't have to stress yourself. I already have my sales 43875, Abi.
Yeah.
What will be my capital employed?
Equity.
Hmm?
Equity
Equity and reserve.
plus loan
See,
bearing interest.
the capital employed you use in row C is always the capital employed you will always use here too.
Okay.
Yeah, I've told you that already. So what's the addition? We got 10
10,238.
So that's how many times?
4.29.
4.3.
That's 4.3 times.
4.3 times.
Yeah. So are you seeing that computing it is actually very straightforward, which is why I really don't want to do it initially, but since you insisted.
It's better the way you did it too. Now we understand better.
For sure.
Then we have current ratio, which is
Current asset over current liability.
Current asset, what the current liability?
Please, can you correct the ratio? It's not ratio.
so in this case now, what will be our current assets?
Financial position.
Which is this, the addition of this plus this plus this. If you use this 14,000, you are wrong. You need to complete it yourself.
7605.
7,605.
What about current liabilities? This plus this plus this plus this.
3802.
So what's the answer?
1.96.
Sorry?
1.96.
2. It's 2.
Approximately 2.
No.
2 times.
1 point what?
It's 2
Nice.
times.
He gave us two.
So
It's
don't just, it's not 2 times, so it's 2:1.
2:1.
It's 2:1. This is current ratio.
Okay.
Then there is the quick ratio.
Assets minus inventory.
Over current liability.
Which is your current assets minus what?
Inventory.
Divided by what?
Current liability.
So I already have my current asset to be 7605. I will check my inventory now. And I have my current liabilities to be 3802. So what's my inventory?
Two
2205.
Okay, 2205.
540.
Okay, so just give me the final answer. How many ratio 1?
1.4.
1.4.
Ratio 1.
Okay, the next one is trade receivables period.
Okay.
What's the formula for that?
Payable.
Trade
Trade
receivable
payable.
all over credit sales.
Yes, sir.
Multiply by what?
100. 365 days.
5 days.
Okay. What's my trade receivables?
5 4.
4860.
4860. What's my credit sales?
4875.
3875.
Good. So you don't have to be looking for credit sales around. Just use your sales. So that's how many days?
40 days. 40 days.
40 days. Then we have trade payables period. Which is your what?
Trade payable or credit purchase or cost of sales.
Exactly. So if they give you credit purchases, use it, but write the formula as credit purchases for them. So let's get our trade payables first. So what's our trade payables?
Trade payables 3105.
3105.
Divided by.
What's my credit purchases?
We're using cost of sales, right?
3713.
3713.
36.9.
That's
37
days.
7 days.
Then what do we have left?
inventory turnover.
So what's the formula for inventory turnover?
As inventory all over cost of sales, closing inventory.
Okay. So see
Or
this
average inventory.
so this diet was a challenge because there's a difference between inventory turnover period and inventory turnover. So I mean it was very, very misleading. But since they said inventory turnover, then that means we have to use the formula for inventory turnover, which is cost of sales over inventory. So there won't be 365 days there because they said inventory turnover. That one is different from inventory turnover period, which is inventory over cost of sales. So inventory turnover is the reciprocal of that, which is this that you're finding on the board. So we already know our cost of sales to be 3713 from up here. And I know my inventory to be 2205 from up here. So that's how many times now?
$14 times.
That's 14 times. So then finally we have gearing ratio. So usually the examiner will give you a clue on the gearing ratio, but surprisingly here they did not. So usually if they don't, I will just use the interest bearing debt all upon interest bearing debt plus equity times 100. So the interest bearing debt is just the loan notes that we have, which is this.
So
which is 27. 27 all upon 27 plus equity. Equity is your share capital plus your reserves. So which is 36 plus 3938. So how much is that?
7538.
Sorry? 7538.
7538.
That's 753. So what do you have in total?
7,539.
7539.
7,539.
26.37.
Yeah, 26 point, let me say 4%.
700.
But they're going to be, this is the formula. I'm going to be multiplying it by 100. Okay, so this you are still fighting for 10 marks here. They only wanted you to compute the ratio for 2019 and 2020. You have only computed for 2019. So the same thing I did for 2019, do for 2020. So 10 marks, you get 10 marks. So they now want you to analyze the performance and liquidity of, just analyze each of these ratio one by one. I mean, year by year. Compare 2019 to 2020. And you know that ROCE, the higher the better. So the ROCE in 2019 is this, in 2020 is this, 2020 is higher than 20, which shows an improvement like that. That's how you would also compare net profit margin. The higher the better. Also, gross profit margin also is the higher the better. Asset turnover, the higher the better. Current ratio, the higher the better. Quick ratio, the higher the better. Receivables period, the shorter the better. Trade payables period, either one, just justify whether the higher the better or the shorter the better. Then you'll be able to explain to the examiner that, okay, he has reduced. This shows that he's paying his suppliers early, and he'll be able to get even more favorable credit terms in the future. If it's the longer, the better you want to justify, explain to them that this shows that he has been paying early, and now the supplier is ready to give him extended credit period. He has been performing. And the inventory turnover, it takes him 14 times to sell all his inventories in his so this one also, the shorter the better for this. And gearing ratio, of course, the lower the better, and in order to keep away from financial risk. So you keep that. That's why you see that the analysis, the marks for analysis is short. So nobody expect that you start writing what is not expected of you. And by the time you read limitation of ratio analysis, then you would also be able to have resolve, and that was 20 marks that. So again, you just have to check, use your point finders to study this so that you'll be able to see this 2020 during COVID, and this. Okay, so I'll be stopping here for tonight, and we're going to be seeing next week. So what I will teach you next week is, like I've mentioned, I will teach you IS 20 and IS 23. That's my priority. Then I would also want to, if I have the time, we'll discuss blockchain and discuss a little bit about ethics, because in your syllabus, ethics. So that's next week. So after that, what is remaining for us is to be solving past questions together. So For us in this class, in my FR class, I want to believe you have been reading, you have been studying. We are going to be sending you mock exams. We'll share it with you very soon. And I don't think this class will be over until you enter your exam. We're going to be together till you enter this exam, just to see if everybody can actually pass this diet. So after next week, we'll just be from diet to diet until you guys say, okay, Oga, who does it do? Let us allow us. But that's what we're going to be doing after next week. I mean, by doing that, we might see some things that I don't think there will be anything I've not actually touched that we have not taught you, because we have covered everything end to end. Everything. That's how we do at Equity. We don't joke with coverage and our deliverables. Okay, so I think you guys should go and sleep. I would.
Yes, sir. What about published account? Is it this one? This one?
Yeah, of course, that will be part of the past corrections. So published account is not like a separate topic like that. So all of those standards I've been teaching you. So by the time you're solving past questions, I will use that to show you how you prepare those financial statements. Just show you how to prepare financial statements, considering some additional information. And those additional information will be all these standards we have been teaching you. So you just see, I mean, additional information like depreciation. They'll give you information about depreciation. Almost all of you should know how to adjust depreciation. You should go to P&L, while the other leg you deduct from the cost of the assets. Or they can tell you additional information around that. Okay, this guy bought a financial asset too, and is intending to sell it at the end of the year. And the share price is now, maybe it has increased. So you should know that that is a financial asset at fair through P&L. And that gain should go to P&L. So that's what I mean by solving past questions. So if you want to have more comfort here, published account is not a separate topic, like, okay, published accounts. No, is just preparing financial statements with some additional information that we have taught you under all of these standards that we have mentioned. So again, when we are solving past questions, we'll solve quite a number of them, maybe 3, maybe 4, I don't know, depending on how many we can solve. Hopefully, we'll solve as many as possible so that you'll be ready for the exam.
Sorry I have a question, please.
Okay, Prudence.
Okay, sorry to take us back or to take you back to the profit before interest and tax. Sorry, can you explain again what made up the 1751? I quite didn't follow when that was explained.
The last question we solved?
Yes, the profit before interest and tax, the 1751.
Okay, so this profit before tax of 1440, they say this profit before tax is after charging all of this, after deducting all of this. So all we just did was to add back this, to add back the interest on loan notes and interest on bank overdrafts, add them back so that we can have the profit before interest and tax.
Oh, okay.
Yeah.
That's clear. Thank you.
You're welcome. I'll see you guys next week. Bye.
Please, can you share? Hello?
Yes, sir.
Please, can you share this calculation, this one that you calculated with this evening? Can you share it with us?
Okay, I will do it right away.
Thank you, sir.
All right. Bye.
Good night.
Good night.